Unfortunately, due to an emergency that came up just yesterday, my good friend and colleague, Professor Mark Guthner of Rutgers, is unable to join us for a live stream today. So what we normally do on Open Interest is probably going to change just a little bit. But we have some things to talk about, I'm sure, today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Interest, where normally at this time we would be getting into a short presentation by Professor Mark Guthner, but unfortunately he's not here with us today. He had some things come up that were rather urgent. However, there's certainly a lot to talk about. We talked on Wednesday about the CPI data a bit. And then, of course, subsequently, we got the PPI data. And the PPI data was not quite as alarming as the CPI data was. In fact, actually, sort of the month-over-month number came in, I believe, at 30 bips, which was spot on the consensus estimate. And consequently, rates fell, bonds rallied, stocks rallied, and so on. Well, in the context of all of this, it's very easy to sort of get whipsawed by these types of statistics. And really, I think the bigger issue is that are the fundamental drivers of inflation or deflation or disinflation intact or not? Most of the time and attention that's being spent at this point is on the fiscal side. So we're talking now about the activities that Doge is engaged in and all of the political back and forth that's going on in Washington over those efforts. I wanted to direct your attention to a website which I think is really interesting called usaspending.gov. So it's a government website. This is not Doge's website. This has been around for some time, and you can find some intriguing things on here. So, for example, you can track how much money is being directed and by what agencies to, for example, media organizations. And in some cases, they will outline what that is for. And that can be pretty eye-opening. Now, before we get too far down this rabbit hole, because it is infinitely deep, I wanted to make a quick point, which is that identifying misspending, if it is that, is sometimes horrifying, sometimes it's humorous. Still, we do have to acknowledge something else. And this isn't just directed to all of you, but to anybody and everyone who is going through all of the spending that they're seeing. And these are really just isolated bits of spending, that, whenever you see something that at its face value might seem outrageous, sort of a big aha moment that proves everything, every negative thing anyone ever thought about the government, I think it's important for us to remind ourselves that statecraft is a non-trivial affair. Homeland security, domestic law enforcement, all of this stuff is non-trivial. And there are infinite shades of gray between black and white. So are there government abuses? I'm sure that there are. And there are probably lots of circumstances where those attempting to protect U.S. interests, whether domestically or abroad, chose paths that they viewed at the time to be the lesser of two evils. So career insiders can't possibly disclose everything to everyone, educate them, and also do their jobs. And that includes both the electorate and even elected politicians. So, one of the reasons our laws are intended to prevent some government agencies from acting within the United States is because they wield immense power, both soft and kinetic. And if those are corrupted, it could potentially destroy the republic. But at the same time, in many cases, these are valuable resources in U.S. statecraft. And it's important to remember, too, that this is, what you might describe an NP hard problem. So you have discrete groups, you have discrete groups of people who are trying to, resolve and find solutions, and they're going to be suboptimal, and so will the overall results be. And just know that every lousy act isn't necessarily a malevolent one, and we desperately do need to overhaul what's going on, because the bigger issue here is the spending problem. Because just like a lot of those small threats that government insiders might be trying to resolve, and for which they're trying to grab government resources and spend, they're not thinking about the big budget. The budget itself is its own existential threat. So whatever the nation does, whether it's by elected officials or insiders, things that may be known or may never be known, we have to live within a sustainable budget, or those efforts will be in vain. So I think one of the things I had said, I don't know whether I went over this on Wednesday, but a lot of folks believe that to get to a sustainable fiscal path, the federal government, assuming we have GDP growth of somewhere in the neighborhood of 3% or so, we can probably, therefore, continue with a deficit of about 3% of GDP or so. And to put things in perspective, our deficit at the moment, which is in excess slightly of $2 trillion, so we have about $7 trillion in official spending, about $7.2 trillion unofficially, $2 trillion deficit, $30 trillion GDP, 3% deficit is $900 billion, and we're currently at 2, so 6.7%. Another way to think of that is that effectively what we're trying to do is identify fiscal cuts in the neighborhood of $1.1 trillion. And again, that's making all of those other assumptions I just described, including, what GDP growth will be. So that's really kind of an important issue that we need to get around. Now, there's one other thing I wanted to add, because for those of you who have watched these live streams, and we've done quite a lot of them, and feel like, boy, Mike's spending awful lot of time talking about what's going on, I just wanted to share. I sometimes share personal background with respect to trading and things like that. There are other parts of my bio, though, that many of you may not know. And that is that fresh out of college, my first job, mine and actually one of the producers for this show, my brother Jay, our first job was actually working, doing forensic accounting and data analytics and recovery alongside Deloitte & Touche as a response to multiple government investigations into possible misappropriation of government contract money to a nonprofit. And I bring this up because this was infinitesimal, of course, compared to what's going on now. But in some ways, I think of that work as some of the most important work I've ever done. Not just because of any malfeasance we may have uncovered, but also because of what the data we uncovered was able to do to protect the innocent. Because what had happened there, just a high-level overview, and if people are interested, I can share more about it. Some of it certainly was public. It was in the papers at the time. So we're dealing 30 years ago now, even slightly more. It started in 1994. So we were young 20-somethings. And what had happened was an employee of a contracted nonprofit agency that received money from New York City government, New York State government, and from the federal government had been embezzling funds. To deflect attention from herself, she made allegations that the organization itself was corrupt and was misappropriating government funds, which, of course, initiated investigations from all of those government agencies, city, state, and federal. Compounding the problem for the agency was that they used anachronistic technology. Data they had was, in some cases, stored on computer tapes, and they couldn't recover it all. So what we did, and more accurately my brother did, was recover a lot of that data, and then we went to work trying to analyze what was going on, and then also put it into the context of government contracts and regulations, because we needed to establish not only what had happened, so it was not just about the money, but we actually had to, it had to deal with allocations to needy independent children, amongst other things. You actually needed to know where all of those people were on specific dates. And all of this was recorded in places that was not easily retrieved. And ultimately, the data that we found exonerated the executives of the nonprofit. These were good people doing good work. And the time and attention of government investigators who were trying to make political hay on this whole circumstance was directed at the innocent by the guilty. And therefore, this is one of the reasons why I feel like that work was so important, because when you really get into it, things can get quite complicated, and you sometimes don't know who the innocent people are and who are the guilty ones. So it's easy to pass judgment, as happened in that case. There were newspaper articles where senior New York City officials were suggesting real criminal activity by people who had not done anything wrong. And even more ironically, the city's controller at the time, a guy named Alan Hevesy, he went on to become the New York State controller. He was later uncovered to have been misappropriating New York State government funds. He was basically using 4 government officials as private security detail for his wife. He had chauffeured cars at his behest. He was directing people to make investments into a venture capital outfit in California, who in turn were making big campaign contributions to him. And he ended up pleading guilty to a felony. He's now dead, I believe. But my point is that in the midst of all of this, there's going to be a lot of stuff flying around. There are talks about the NIH funding steroid-induced fights between hamsters. That was actually one of the things that the NIH did actually sponsor many years ago. They put the kibosh on that. But I, encourage people to do their own work and understand all of that, along with the fact that there are parts of the government that does things that we don't know and probably never can know. So, with that, I think we can kind of move on a little bit. And by the way, if anybody has questions about those types of things, as you probably have gathered from the way I talk about things, that, I'm very happy to share those types of experiences when I think whatever I glean from it is relevant to the broader conversation. And I bring this up also because one of the criticisms I keep seeing coming back again and again with respect to Elon Musk and the people at Doge doing the work that they're doing is, why don't we just get auditors to do it? Well, I can tell you that in my experience, first of all, the auditors generally work with the financial statements that are put in front of them by the people who are running the organization. That's by design. You can imagine that when Deloitte or Ernst or any of the big accounting firms go into a publicly traded company, they're presented with the financial data by the company, and they are supposed to attest that they believe that it is representative of what's going on or not. It is a very different thing to simply open the front door to a business and send somebody inside and say, what's going on here? Where do you begin? Where are things hidden? First of all, people who are trying to hide things from accountants or auditors are oftentimes in that whole area themselves. And so they would know how to do that. And this kind of, forensic data analysis, research, and work is extremely complicated, even at a small business. At the level of the federal government, it's almost unimaginably huge. And the approach that needs to be taken is going to be a little bit different. So I would just offer that as people think about this. And by the way, some of the stuff that comes out, Sesame Street in Iraq or whatever, it should also be said that these are mechanisms by which the government tries to exert soft power abroad. And that is a part of statecraft. Whether or not you think that's the right way to do it, that's another matter. Whether we actually have the money to do it, demonstrably we don't have as much as being spent. But a lot of what might look at face value like questionable expenses might actually have been, in a strange way, one of the better things we could have done at the time in a world of imperfect choices. Okay, so with that, I'm going to just bring up Unusual Whales. Oh, by the way, I think we're going to put a link to this in the description, and I can confirm, because I didn't know this before, but if you happen to sign up for Unusual Whales via the link that we provided, I don't know that there's a code, but I believe if you just click on that link, you get a 20% discount on it. And we also, by the way, are apparently going to get a fee. This channel has been completely uncompensated in any way before now, so I'll just disclose that we would get a fee. But you can see I'm using it and I like it, and if you like it too, then you get it through us and get a 20% discount. I think they're also running a sale. I think their current sale is like 15% off, but that's totally up to you. Okay, so let's take a look at some of your questions. Spicy Barbecue. Hi, Mike. Just a comment. I sold covered calls on 2 stocks, and the stock price shot right through my strike. The only thing I did was sell out of the money cash covered puts. Is my strategy reasonable? So, okay, so now you are, just to be clear, Spicy, the way I read that, you're long the stock, and now you are also long, short well, if they are the same strikes, you didn't tell me whether it's the same strikes, but if you sold cash covered puts, you may be either short a strangle or short a straddle, depending on which ones you sold. So, for example, if the stock's trading 90, I sell the 100 strike calls. The stock goes to 110, I sell the 100 strike puts. So I'm short the puts and the calls. At this point, I'm long the stock and short the straddle. If it went to 105 and I sold the 95, so I'm short the 95 100 strangle. That's an okay strategy. I would probably prefer that it's a strangle, not a straddle. Now, I will tell you that there are some very big hedge funds that engage in this kind of strategy with the following rationale. And Glenview is one. I think Glenview is still around. We used to do business with them. They did this a lot. Omega, which is Leon Cooperman's shop. He, I believe, was the former head of Goldman Sachs Asset Management, but he runs a hedge fund and has for a long time called Omega. And it went something like this. They would buy stocks long that they liked. And if the stock rallied somewhat, they would, okay, so you just added, yes, different strikes, just thinking to even out my deltas. Okay, but you're evening out your deltas on the option side, not overall, because the stock is 100 delta, or it's one delta or 100 delta, depending on how you think about it. So straight linear exposure plus a neutral options exposure. So what were Omega and Glenview doing? Well, if they bought a stock that they liked and that stock rallied somewhat, they might sell some upside calls. Number one, to take in some premium, of course. And number two, maybe they felt like at least between now and the expiration of the option call that they were selling, that they felt that the price had become full, let's say. And there can be a lot of reasons why you don't just sell the stock. You may still like the stock in general, but just don't feel like there's as much upside to your potential price target as was exhibited when you first entered the position. That's part of it. There are tax consequences to selling an appreciated stock position that they may not have wanted to incur. They may have felt they could enhance their return somewhat by collecting that premium. And then if the stock fell, and was getting close to levels where they might be inclined to add to their position, they would sell downside puts. And consequently, what they would have is a long underlying equity position and a short strangle around it. And they might do the same on the short side. You're short a stock is coming in, you want to squeeze a little bit more out of it. There's a level at which you'd probably be okay covering it, so you sell a downside put. And, worst case, the stock goes down to that strike and you cover your short at that level and collect a little premium in the meantime. So as a strategy, I think that's totally fine. I just would urge people doing this to think about the following, which is that when you identify strikes where you'd be happy to sell a stock that you own, or you sell a downside put at a strike where you think you would like to own it if you don't already, bear in mind that this sort of goes to that whole conversation about what tenor you choose, how far out in time you go. Because what you're going to find is that, let me see, where's my, do I have the Bloomberg terminal going? I thought I had Bloomberg going. Where is it? This is interesting. Did it quit on me? Let me bring this up really quickly, because I want to just come up with a couple different stocks to provide examples. But actually, we'll do this with, this was actually, I was going to look at something more in terms of the fundamentals and really try to dig into that. But let's just pick a stock. We can pick a reasonably volatile one and broadly held. So why don't we choose NVIDIA? Why not? Okay. So now we're going to take a look at different potential expirations and give some thought to essentially, let's see here. Bear with me for 1 second. Here we are. Where did I? This is one of those things where you can tell that I haven't done this quite as often in here as I do it in. Oh, I put. Here's my Bloomberg. Yeah, I must have accidentally closed this somehow. Excuse me. And I appreciate your patience. This is really as off the cuff as I almost always am. I'm even more so now. So one of the things you're going to observe is, let's just say, as we've previously discussed, you wanted to sell a 20 delta strangle on a stock, which is fine. If you sell a 20 delta strangle that expires in 2 weeks, the probability that the stock is going to violate those strikes, theoretically, is no greater than if you sell a 20 delta straddle that expires in 2 months. But it makes a huge difference when you think about the value of the business. And let's just walk through an example of that to illustrate the point. So we'll go out we'll go out 2 weeks. We'll look at February 28th, and we're going to take a look now at the 20 delta strangle and see what strikes those represent. So on the downside, the 20 delta put is going to be one of these, the 124s or the 125s, okay, with the stock at 137. And the 20 delta calls, let's call it 125, keeps the math easy, right? It'll be easier for me to remember anyway. And on the upside, the 20 delta calls are going to be the 155s, okay? So the stock's 138-ish right now, and the 20 delta strangle is the 125 strikes, which is down 9.5%, not quite, 9.4%, and the 155s, which is up 12.3%. Well, now let's go out 2 months instead. So 2 months instead is going to take us straight out to April expiration. What is that 20 delta strangle going to look like? So that strangle, the 20 delta put, right over here, is about 117. Okay? And the 20 delta call is going to be up near 160. So what you're getting is the farther out in time you go, the more you're playing into your fundamental thesis of what you think a company is worth. Because if I chose a 20 delta strangle that expires in 1 week, I'm essentially taking a punter view on whether the stock could rise or fall 5%. And 5%, this way or that, there's nobody who has enough precision with respect to their valuation of a business to nail it down so precisely. Analysts will tend to, we can take a look at that right now. Analysts are going to tend to have a very specific target price that they throw on it. How much is NVIDIA worth? Well, David O'Connor over here at BNP says 170. And Vijay Rakesh at Mizuho says it's $175 a share. Well, what they're doing is they're taking a handful of what they view to be the critical inputs, and they're putting it in, and it comes spitting out as a single number. But the truth is that, there's a little bit of guesswork into every single one of those. So you have multiple variables going in to establish the present value of some asset, and all of those are unknown, and you're estimating all of them. So it's very, very fuzzy. And my point is that when you get into high vol stocks and you go further out in time, your margin for error becomes much, much greater. So that's the balance you're trying to strike. So I would offer that. But I do like the strategy, and it's commonly used. Michael Anthony. Hello, Mike. Hello. On the Fidelity website, that looks like 3 different funds bought shares on February 13th, but I'm not sure. But I did see a 13G filing. Maybe you can look and see if I'm correct. On HLF, Herbalife. Oh, okay. Forgot to give me the company. Well, let's take a peek. So, let's have a peek here. Get in here, Ticker Explorer. So, incidentally, I would add one other thing just about, if you're dealing with something like, this is the insider, sorry. So this is gonna be the people that are actually working there. That's not what you're just talking about the 13Fs and so on. So, oops. By the way, the company I used to work for at one time had a big position in Herbalife. So when I worked at Ivory Capital, Herbalife was one of the names. I have previously described this. I'm a little discomforted, shall we say, by their business model as a multi-level marketing organization. I'm a little unconvinced that the business is really hugely beneficial for the participants in that. It's, some people will disparagingly refer to these as these multi-level marketing organizations as pyramid schemes. I'm not going to completely get in on it. I will say this, if you haven't seen it already, Bill Ackman got short the company pretty famously, it should be said, and painfully as well, because he shorted a huge percentage of the company, and he did some extensive work and then made that very public. And then other market participants, recognizing that he had this huge short, took advantage of the situation, perhaps most notably Carl Icahn, and basically, initiated a squeeze on him. And by the way, if you Google Battle of the Billionaires, Bill Ackman was on with Scott Wapner on CNBC that day. I don't know Carl Icahn personally. I don't know Bill Ackman personally. I do know Scott. And And I know other people that were involved in that program. And the interesting thing that you'll notice is that the conversation begins with Bill Ackman, and he makes his case, his bearish case. And then they say, hey, we've got Carl Icahn on the phone, and he'd like to have a word. And so he jumps in. And one of the things that I've always found quite fascinating was that, Bill Ackman never really asked the question, how did Carl suddenly call into this show? I think he might have been interested. But it was a very interesting conversation. It was certainly one of the most engaging segments in business news television that I have ever seen. I was working at Cantor Fitzgerald at the time, and I can tell you that the way it works on these big trading floors, CNBC is on screens all around the room. There's hundreds of people in that room. CNBC is everywhere, but you don't hear it because the volume's not up. People are just, you're on the phones, they're talking to each other, they're doing their thing. Everybody's very busy trading. If you need to hear something, what we called the hoot and holler. So the hoot and holler was something so that all the trading desks at the firm were able to communicate with each other. You would have something that looked like a handset, like you might see on a two-way radio, and you could broadcast to traders everywhere, not just on that floor, but around the country or even the world. And that's called a hoot and holler. And on the hoot and holler, there's a lot of different buttons, and those buttons have little volume things on it. And CNBC is one of the buttons. So if you see something that's going on one of the screens around the trading floor, and suddenly you think, I want to hear that, you can press that button and turn the speaker up a little. Now, in a big trading floor, there's a constant hum. It's like walking down a New York City sidewalk. It's just not quiet, ever, until that day. I can tell you it was astonishing because when Carl and Bill started getting into it, the whole floor quieted down and people started turning up their speakers. So the Battle of the Billionaires, if you haven't seen that segment, it's a good one. It's worth a watch. It's pretty humorous. So I encourage you to go back, even though it's probably no longer relevant. So where is Fidelity in here? You're saying that Fidelity did something, huh?
February 13th. The 13th, that's not going to get that up to date.
Let me see. So here we are. Oh, this is probably worth noting. So FMR, I had some good friends who worked as fund managers at Fidelity. Two of my classmates, and one was a lifer over there. I think he may have retired by now, but were fund managers. Fidelity Management and Research, that's the mutual fund institutional side of the business, if you can imagine that. So when you're looking at these things, you can sometimes when you look at 13Fs, you see Vanguard, BlackRock, those are pretty much passive ETFs. And Fidelity, because when you open an account, a lot of the securities you hold, chances are wherever you hold them, they're not in your name. They're in what's called street name. So if I have an account at Morgan Stanley and I buy 10,000 shares of ABCD stock, I would say XYZ, except it was pointed out to me that Block, I believe, or who is XYZ? XYZ is actually, it's kind of a default, people say, oh, XYZ, yeah, it's Block. So Block changed their ticker symbol. So XYZ is not a generic catch-all for a stock ticker symbol anymore. It's now what was formerly SQ is now XYZ. But when you buy securities, they're held in street name. It's an accounting, basically a ledger that says, okay, the firm owns all of these shares, but they have an accounting ledger that says these are for your benefit, those are for somebody else's benefit, and there are reasons why that's easier. The issue that comes up though is that when you start looking at the holders, you will see an organization and you'll see a big block of stock, but that big block of stock may not necessarily be, a single individual. You see some broker and you see all of these shares, and a lot of times that's just in-street name, rather than being in the names of the ultimate beneficiaries. In the case of Fidelity, so Fidelity has a self-directed brokerage platform, which I'm sure a lot of people use. I think at one point I had a self-directed Fidelity account many years ago. But then they also have these, what I've just blown up here, which are the actively managed funds. Okay, so when you look at this part, this is fund managers making a determination. So the Fidelity small cap, well, that's an index fund. So actually the index fund, that one probably is a passive fund. But one of the ones that's more strategic and is actively managed, and you'd have to actually go in and do the work to see which fund is which. Those can be determinations that are being made by individual fund managers. And of course, as we described on the last live stream, an important consideration is that also this information's a little bit stale, right? Because they only have to file their 13Fs.
Yeah, he said February 13th on the Fidelity website.
On the Fidelity website. Let's see. Okay. So, yeah, I mean, yeah, maybe you could post a link to what it is that you're looking at, and we can look at it together. And also, I mean, in some cases, you're going to find certain entities, depending on the size of their positions or their status with respect to the company, have to make filings with greater frequency and more up to date. So if you're below 5% and you're a passive shareholder and you're not an insider, then you might not necessarily see information as quickly as you would if you are any of those things. So when one is more than 5%, and when one does have an intent, for example, this is something that they were going into Elon Musk about lately. When he was buying Twitter, he had started to acquire the shares. And once he got over 5% and continued to acquire, that changes things with respect to the filing requirements. And I'm not a securities lawyer with all of the details of what is required right at my fingertips, but I can tell you that right now what they're going after him about has to do with one of the subsequent filing requirements that they said he did not do in a timely fashion once his aggregate holdings exceeded 5% of the underlying shares. So anyway, okay. I'll if I can get back to that, I will. But okay, good Saturday morning from Asia. Appreciate your commentary, illuminating, and good luck into Unusual Whales. Yeah, thanks. Good. Max Convexity, good day from Austin. One of my favorite cities. As you guys probably know, I lived there for 5 years and miss it every day, pretty much, ever since, except for Cedar Fever season. That I don't miss so much. But everything else about it, I pretty much do. Steve Garcia, recently it was announced that the New York Stock Exchange will increase trading hours to 22 hours a day. Will other exchanges follow suit? How do you think this will affect volatility of stocks and derivatives? Okay, so there's the volatility issue. I expect that volatility will still get greater outside of conventional trading hours. So 2 o'clock in the morning domestic time, I would expect that volatility could be greater because liquidity will be less. So, liquidity tends to have a stabilizing influence most of the time on asset prices. So, the lower liquidity during those off hours probably means that the volatility will also be higher in those off hours. But the thing is, don't forget that you can trade stocks after hours anyway on ECNs. So, and I'm sure, many of you probably have done. So my point is that although the volatility will be higher during those hours, there's a chance that in general, that volatility will be less than it is now, because you're going to have more market participants than you currently do. So relatively few trade on the ECN. So when we look at a stock that's trading after hours, after they report earnings and it gaps, how many times have you seen the stock gaps this way or that? But by the time the market actually opens the following day, things have calmed down a bit, and you're actually closer to the prior closing price than you were overnight. So my expectation would be that although the volatility will be greater in off hours and liquidity will still be less, it will be greater than it is now, if that makes sense. There is something else, which is that if the regular listed trading is open, then it is also possible that they could extend options trading hours. And I would kind of expect that. The other thing is that as liquidity goes up, for those that are trading options by hedging their deltas, this is a benefit, because the options pricing models assume continuous pricing and prices. Neither of those are true, by the way. But the more continuous they become, the better that is for those that are trading vol. So it could actually have a stabilizing effect, but if all you are doing is looking at listed pricing, and you'll say, well, it's more volatile in the after hours. Yeah, well, it is now too, but it's just not trading on the exchange. Okay, BABA earnings next week. Huge run up over the past month. Daily RSI 85, very overbought. Expected move is about 10 points. Do you think a strangle swap is a good trade? Excellent question. So let's take a look at the historical moves for BABA first and relate that. To what's going on right now. And then the other thing I'm going to do is I'm going to say, let's take a look at a long-term price chart in BABA, because yes, you can see here it's had a huge run up. A lot of people are sort of coming out and saying, the China trade is on, but I think we also need a little bit of context. So let's just take a look at a longer period here. So this is where we're at. Okay, so 10% implied move. That's about what we got the last time. Prior time it was down 8.5%. So up almost 11, down 8.5, up 8, down 31.68%, flat. Up 16.8%, down 3, up 22.5%. Down 1.5, 13.6%, 6.25. I don't know how you read all of that, but you've got some big moves in there. So I don't think 10% is all that big given that historical context. And it might, we could say that's even more true given how much the stock has moved recently. So if investor expectations prove to be unfounded, or if they underestimate what's going on, consider this. This thing's moved 56% in a single month, right? So a 56% move in a month off of, let's see what the volatility is here. So the 60-day realized volatility is 41.5. All right, so we can do a little bit of quick arithmetic and figure out how many standard deviations that is over the course of 1 month. So the square root of 12 is 3.5. Round numbers is really 3.46. So we'll just take the implied vol of 50, divide that by 3.5, is 14.3%. 14.3%. The stock has moved 56%. It has moved more than 3 standard deviations on that vol. So are options overpriced? Well, doesn't seem like it. Not based on the way the stock's moving around, especially with this catalyst, right? So the realized volatility is 41, but then you've got earnings, and then we saw those big moves in there. So if the underlying volatility process is 41, it's trading implied at 50, and you have this big unknown, that's not crazy. It's not crazy overpriced. It's expensive, but it's not nuts. So I'll begin with that. However, sometimes what you get is an anticipatory move going into an event that ends up diluting the move on the catalyst itself. So as information, maybe it's leaking out, or people are divining a company's results in part by seeing what's going on at their competitors or getting other bits of data about what's happening, you might actually have a situation where the event turns out to be a bit of a non-event because a whole lot of it got priced in already. But why don't we do this and just take a look really quickly at what the construction of a strangle swap in this thing might look like. And for the sake of argument, I'm just going to do the March 28th. We'll do that as a, so we'll choose again, we'll just do something close to 20 deltas on both sides, and then we'll go out further in time and do the same. So that's going to be like a 110, 150 if you're using March on the short side. And we need to ensure that we capture the next event, because if you're going to do this trade, you don't want to just get annihilated on the vol crush on both sides. So you need to have at least May regulars by the looks of things. So we'll add that in. Oops. Well, June would be fine too, but I'm just going to make it fairly straightforward for now. So that'll be, if you want it to be in perfect alignment, so you're doing 2 straight calendar spreads, that would be like 110.50 like this, and you're going to end up with something that looks like that. So you make some money if the thing drops down to that lower strike, and you could potentially make quite a lot if it runs up to the higher one. So not terrible. The thing to keep in mind is take a look at the break-evens. And this is assuming the long-dated vol doesn't really change that much, which may or may not be completely accurate. But it's also not really pricing in completely the vol crush on the near side, which is also an important consideration. But that's a pretty big spread, right? 105 to 170-ish. So you have some room, but, you know, it's not a huge amount of room when you consider that the stock was, where was it? It was 100 last week. And it's trading 124 now. So if your downside break even is 105.61, you know, this is where you live. It's right in here, right? So that's your break even on the downside. And of course the upside break even is going to be, you know, over there, but it hasn't been at that price in quite a while. Which actually brings me to my other point, which is, let's just take a look at some fundamentals here. One of the reasons that there is so much potential upside and that we've seen this kind of move is because compared to other companies that exhibit, at least on paper, you know, the top and bottom line growth numbers that BABA has been exhibiting and are in a critical space. You know, BABA came out right after DeepSeek and said, our AI models are better than DeepSeek's. So that had a lot to do with it. So you've got a big piece of the AI trade, and then you have this other thing. I have to switch this to dollars because just so if you're looking at this, you don't say, oh my goodness, this thing is trading 2 times earnings. No, it's not. Because that was actually in won. So 125, full year earnings estimates of 865, 14 times earnings. Full year. What are we looking at here? It's trading 12.8 times next year's estimates, and that's not really probably sufficiently modeling whatever the AI impact is. $300 billion market capitalization on an $18 billion free cash flow. So you're looking at a 6% free cash flow yield for full year 2025. And by the way, full year 2025, keep your eye over here. Full year 2025 is almost over because their fiscal year ends in March. So that's really, last year we're mostly done at this point. So this is the number. If you're thinking forward, it's a blend between this and this, but it's mostly this. So let's just call it 22 billion on 300. That's a 7.3% free cash flow yield. Now, I want to just point out, so the company is still, if these numbers are to be believed, then, and if this was a U.S. company that had these kinds of numbers, you'd buy it all day and twice on Sunday. No question about that. Chinese companies, it's a little bit trickier because there have been instances where things weren't quite what they seemed. There have been instances where the government has behaved capriciously and prevented businesses from expanding or done other confiscatory things, or suddenly Jack Ma disappears and nobody's seen or heard from him for a couple of weeks. And then, he pops up, oh, it's all good. Well, these are risks that we have to acknowledge, and you have to discount the value of a business. I would like to say accordingly, but accordingly suggests that I actually know what the probabilities of those respective outcomes are, and I don't. The other issue that I have is that, completely independent of Alibaba, it is a geopolitically fraught region to begin with. We're constantly concerned about when, if, and how China is going to potentially go and take over Taiwan. And we have other uncertainties, not least of which is a potential tariff war. So all of those things, and all the ADRs, because of the way they structure these securities, the American Depository Receipts, it's not like it's the equivalent of owning a common share of stock in a U.S.-based company with respect to your legal rights. So all of those things are going to discount it somewhat. It wouldn't discount it so much if it was, say, in Germany or France or the UK, but it is you have to give it a little bit of a haircut for those reasons. But once you've sort of come to terms with that haircut, the company is incredibly cheap based on its growth, its free cash, its price to earnings, and also the fact that it's in critical areas that everywhere else would have assigned it an obscene multiple. Okay. So, one quick thing, Steve, I just want to point out, if the thesis is that it's overbought and that you are putting on that strangle swap because you are concerned that the stock could roll over, just do the put spread side. Because if you saw that strangle swap payout, what you're going to notice is that structure mostly benefits on an upside move, right? So a lot of the premium you're spending is going to be focused on that. You might instead contemplate, and I should have said this straight off the bat, getting something that looks a little bit more like this, where you're taking the direction that you believe. Now, I personally think that it seems like investors are coming back into it. The price action doesn't suggest to me, and earnings is, all of those risk factors I just identified, those aren't going to come up on the earnings call. No one's going to say, oh, by the way, we're invading Taiwan. That doesn't come up on the BABA earnings call. They're not going to say, oh, China's taking over the company and, you don't own it anymore. That's not going to happen on the earnings call. So that type of a risk, it isn't going to reveal itself. It would be probably related to pushing back expectations on the AI side. It would be just disappointing on the financial results and the expectations. Those kinds of things are the downside risks to me at this point. And, you might try to figure out what the whisper number is, that kind of thing. Okay, so let's see. Second. Where did I put this?
How do we know the blackout period ends?
Yeah. Let's see here. Can't really get that on the screen. Oh, you just popped it up. And I just lost the question. How do we know when the blackout period ends? How do companies determine? Okay, so you got two questions in here. What is a good price for their stock to buy back? For example, Lyft announced $500 million buyback. Quarterly earnings release was earlier this week. Okay, so, yeah, they're not supposed to be. Okay, so the blackout period leads into their results. The idea being that they're not supposed to be acting on proprietary information, although that's kind of a bizarre way to think about it, right? Because a company always has, the company knows what's going on, and they're the ones that are affecting transactions in their own stock. The potential benefits, interestingly, if you think about it, all that is, it's in theory just accretive to the shareholders, right? You're taking shareholder money and you are using it to purchase your own shares, which means that everybody's shares represent a larger share of the company. It's a mechanism by which you can return cash to shareholders that is, there's two real drivers for this. One is a legitimate one, which is tax. They have to pay corporate income taxes, but the holders of stock do not have to pay taxes on any potential distributions. So if you're a small holder and you get a qualified dividend, then that's not really of an issue to you. But if you're a big holder, then you may have taxes on those dividends, and that's a slightly different problem. I'm going to go to Apple because that's obviously a big one. And, you can see, if you go back in time, how they have executed their purchases over time. And I'm sure that this is in Unusual Whales as well. And actually what I can probably do, because I haven't used it for that, and this is one of the things I should probably do. Maybe I should just ditch my Bloomberg and force myself to use something else, because then it doesn't, it won't just be that's the earnings moves. Let's see here. I'm sure it's in here somewhere. Did I put in buyback? Stock buyback. All right, that gives an explanation. I'm sure there's a function in here that will allow one to do it, but it's not muscle memory for me to do it in that one. 20 years of using the Bloomberg machine to do this kind of work, and this is how it turns out. So if you think about it, some are very deliberate in their approach. Warren Buffett is, with respect to Berkshire. So, he has a couple, and you can read about his approach to this. But, he looks at his own stock like he looks at any other. And, he's unique in that respect, because most big corporate managers, they are not actually in the business of buying whatever stock they think represents the best value. When he thinks that his is trading under his expectation of book value, he buys his shares back. And as well he should. That one shouldn't be too hard to divine because he's carrying so much cash on his balance sheet at this point. But, that's a good example. And, for most of them, as you can see, they tend to, do it pretty regularly. Just acquire the shares over time. Are there prices at which some will not act? Probably. But you can usually just find out from their own disclosures what their target and time frame are, and just assume that for the most part, unless something crazy happens, that if they have a buyback budget, they're going to deploy it, and probably over the calendar that they describe. Okay, FinWest. That's the reason I took off any Chinese company from my watch list and no longer trade. Too many unknowns and not reliable. It's funny. It's a little bittersweet for me to see what's going on in Baba, because it is a name that, as it was languishing, I thought sooner or later people are going to pick up on the fact that there is some value here. The company just continues to grow, and my thinking was it's got to come back to life sooner or later. And it was probably back in this time frame here that I was doing this. I remember it was in the 80s. So, yeah, it was in mid-early 23. Yeah, so it was probably back here in March, April time frame that I had picked up some Baba on that basis. And it got this rally, and then it rolled over again, and I just said, you know what, to hell with it. There's just too much I don't get. And the price action seemed so unhealthy at the time that I was just using that as a clue that maybe somebody else knows what's really going on. Because the Chinese companies, I never really knew what was going on. And the other thing is, I was a little bit jaundiced, I will admit, because I had a friend who worked for a company and was stationed in China for a time. And what he told me scared the hell out of me with respect to investing in China, because it really seemed like there was a lot of excess in places. It was really hard to figure out what was going on. The example he provided, I may have told this story before, he lived in one of 4 50-story apartment buildings, and that had been built on spec. And he didn't speak Chinese, he couldn't read it. He actually was born in Russia. So Russian was his first language, but he's been living in the United States since I think he was 10 or 11. And he lives in the Bay Area now, and he's in the software business, but he was out there. And he described this whole situation, and he said that he would go to his office, and in order to find his way home, because he couldn't read Chinese and it's kind of easy to get lost, he said, I'd leave my light on. I said, what are you talking about? That doesn't make any sense. He said, I'd leave the lights in my apartment on so that I could figure out where, which one was mine and where it was. What he was telling me was that those buildings were empty. There was nobody living in any of them. He himself, one person in one of the 50-story buildings, could leave the lights in his apartment on, and he would be able to identify it at a distance. And I heard that, and I thought, oh my God, how could you own a Chinese stock with that kind of stuff going on? So, it's an anecdote. It was many years ago, but it's been very difficult to really have faith. Tucker D. Dog, as reliable as all the memes about Chinese measuring tapes and tools. Yeah, maybe. And look, I'm part Chinese. This is this is not some kind of a jibe about Chinese people. I'm just talking about China and some of the things we've seen. Very disconcerting. So, anyway, yeah, I guess we've used up an hour and 5. That takes us to after 3 o'clock. And I'm on fast money today, and I'm sure they probably banged out a whole bunch of emails to me about what we might potentially talk about. So I'm sorry that Mark couldn't join us today. For those of you who did decide to stick around and just sort of do this off-the-cuff thing, hopefully he'll be back with us next week. And hopefully the thing that he had to attend to resolves itself in some decent way. But in the meantime, like, subscribe, notification bell. If you're interested in Unusual Whales and you do want a discount, then follow the link in the description and take a look. And if you do that, we're all using the same system, then we'll at least be able to, you know, go back and forth and opine on things that way. And I think they have a community feature in there too. Actually, I want to show you one other thing, which I happen to think is kind of a slick feature, and this is, you know, admittedly a little bit sales pitchy, but I reached out to these guys. They never reached out to me. I started playing with this thing and thought it was pretty slick. This is how often they're making enhancements. You just go right to the top over here and you see the changelog, and you can see all of the stuff that they're doing. And it's a lot. I mean, look at this. I mean, it's like every other day that they're making important improvements. And they have this, you know, for those of you who want to communicate with each other in some kind of a chat, this is a feature that they added, which I also think is very slick. And although I haven't spoken to JJ Kinahan or to Tom Sosnoff, either one of them in quite a while, other than to say congratulations to JJ when he went back to work with Tom and Bat and all those guys once again. These are thoughtful people, and you know, I respect them a lot. And I thought it was kind of interesting that, and I don't use Tasty Trade, right? So it's not an endorsement of them, but I like those guys, and they're thoughtful people, and so their alliance also gave me some reason to reach out to the team at Unusual Whales and say, I just want to learn more about what you guys are doing, and because I think it's really slick, and it is. So with that, I hope you all have a really pleasant weekend, and I look forward to joining you all next week. I think Monday is a holiday.
It is.
So I may do a live stream, but we don't have the markets. But I'll definitely be back on Wednesday. Thanks for watching.